I'm Eric Verboncouer. I'm going to be facilitating the panel, and I'm with Headway, and I'm one of the partners there and a founder. And really, my role is in operations for Headway, and we exist across the spectrum of innovation, which is really early stage entrepreneurs all the way to corporate innovation. And that's really what my proximity is to finance. Not as deep as the panel here, which is why I'm the moderator. The first thing I want to do, though, is thank Startup Wisconsin, thank our sponsors. Clearly, there's been a lot of work that goes into putting these events on all week, and there's been a lot of involvement with time and resources in order to make that happen. So hats off to our sponsors for believing in the community and really creating these opportunities for us to network and to learn and grow together, which is a big part of what Startup Wisconsin is. I'm really excited for this discussion today and this afternoon. And really, it's with this all-star cast of financial leaders that really represent a diverse perspective across the state of Wisconsin and the different opportunities that you have to receive investment, whether that's a grant, whether that's an actual round, all the way to a priced round, whatever that might be. But there's a lot of opportunity right here in the state of Wisconsin. And my goal today is to showcase what is available, but also give you some takeaways, some actionable advice of here are the things that I need to do as an entrepreneur, as an innovator, to really structure my business in a way where I'm going to be able to receive funding or a grant or what that looks like, just to start to level up and increase your knowledge. But first of all, I want to start by allowing everyone to introduce themselves and give you an idea of who they are, the organization that they represent, and maybe just also talk about the type of businesses that you're investing in or handing out grants to or whatever that might look like. So we'll start off with Cordero.
Thank you, Eric, for obviously for moderating. So Cordero Barkley, I'm a partner with TitletownTech, an early stage venture capital firm started by the Packers and Microsoft based here in Green Bay. And we invest in early stage tech companies, so pre-seed to Series A across a number of verticals. If you log onto our website, you can see them versus me listing them all off. But we really, for us, we really enjoy founders who are solving real and meaningful problems. And, right now in this current environment, which I know we'll spend some time talking about, it's been interesting just watching how it's evolved since we started in 2019 until now. So look forward to continuing the conversation as the panel moves forward.
Naletta?
Hi, I'm Naletta Sanchez. I am with Wisconsin Economic Development Corporation. I am a Regional Economic Development Director for Northeast Wisconsin. So as a state, we have a variety of different programs that we represent. And we help businesses across various different stages of business, from whether they're doing startup or whether it is looking at advanced manufacturing and growth and expansion in those initiatives. It's really our goal is to help build a strong economy in Wisconsin, and that means everything across the board as it comes to business development.
Great, thank you. Matthew?
Yeah, my name is Matthew Key. I run a group called Tundra Angels, and we're an angel investor network. And we also, like TitletownTech, invest in high growth, scalable companies from pre-seed to Series A. I would just add, for the sake of context, the way that we're different from TitletownTech is that TitletownTech is a venture fund. We don't have a captive fund. We have a group of 45 investors who all make their own decisions on which companies to invest in and to when, and we call capital upon every investment that's made. So I don't have a captive fund, but members pay an annual fee to be part of the group, and I run the group full time, and so prior to this, I was a former startup founder, so kind of on the other side of the table, pitching to investors like myself, so that's the group. We invest all over the state of Wisconsin, and 16 companies, about $3.5 million deployed so far.
Awesome. I'm Dave Sachse. I do venture investing with my family out of our family office, out of a fund called Sachse Family Fund. And we do pre-seed to Series A, with majority of our checks being pre-seed or seed stage. To date, we've done 60 deals, 40 direct investments into startups, and then 20 into other venture funds. And as far as something else I do is I lead a global community of family offices that collaborates on all things venture capital. And that group is called Family VC, but it's my way of creating a community of value that can support these founders, both pre and post us investing, and that's a little bit about me.
Thank you. Wendy?
Excellent. I'm Wendy Townsend. I work at the City of Green Bay. I work in community and economic development, and I work with a couple of revolving loan funds for the city. So we help create a vibrant community with lots of diverse businesses. So we have a diverse business programs and loan, and we have other community development resources for business and startup, and also advancing when they're ready to hire employees and things like that.
Great. Well, thank you for the intro, and thank you for taking the time to be here today on the panel. The first question that I want to ask is really kind of orientating towards the environment that we're in. We hear a lot about the economy right now. We hear a lot about inflation, increased interest rates, the Fed, like all these different things when it comes to raising capital. And the first thing that I want to do is just ask the panelists, like, how does this current environment really alter your strategy in investing, or alter the way that you approach qualifications, or, what's changed with the current economic environment for you, and how does that change what you look for?
I can go first. The perspective of investing in both venture funds and direct startups. I mean, on the fund side of things, we've been very patient capital. We haven't wrote a new LP check since February 22, partly because of some of the inflated metrics and the high hyperactivity in 2020 and 2021. But as far as direct opportunities, I mean, it's a year of bridges and venture debt and all sorts of stuff. As a family office, you can get very challenging bridge deals. So maybe not attractive bridge deals like TitletownTech may see, but so been super patient capital, to say the least. Even some deals that have been very attractive when it's a team and the team, what they're building and the traction that they have, the terms still weren't there. So being patient, I mean, I've even had one deal where I waited 4 months and the terms came down to an area where I was more inclined to invest. So being super patient capital is one. And then just for family offices in general, with the macro environment, there's a lot of opportunity costs in other asset classes outside of venture. So with venture being so illiquid, it can be super challenging to get family offices to invest in this time if they're not at a certain scale with deploying to different asset classes, just due to the illiquidness of the asset class. So it's a lot harder to approach family offices in this environment if you're not getting teed up in kind of a right manner here as well. But that's some of the stuff that I've seen currently in the macro from a family office perspective.
Yeah, that's a great perspective. Anything at the state or city level that's different?
I can take a little bit of it. From the city's perspective, we're noticing that we have our interest rate is set, and right now, depending on what the economy is doing, our interest rate may or may not be a good thing. So right now, with interest rates going up, ours is set at 4%. So ours is looking really attractive for individuals. Now, our funding at the 4% is a revolving loan fund. It's really for a scaling up company that's going to have employees. So we know that right now, we just closed on a deal last Friday, and all of our funds are out for the year. So we're kind of at the latter part of the year, but we'll get replenishment now. So it just really depends. But right now with the economy, our city funding seems to be more favorable because we're gap financing. Usually they can get something going on for a primary lender, and then we come in somewhere in the mix of whatever they have organized, either their personal capital or whatever is that they're working with. The capital stacks are becoming more and more creative all the time. We've had traditional financing is hard, and it's difficult to get sometimes. And so again, we're trying to be more and more creative and think of new ways to solve old problems, I guess, as funding is something that's been around for a while. So right now, the city's fund is really doing well. And but again, that's what we're finding, is that there's a lot of activity in our house. When interest rates fall low and under the 4%, we're not moving out as much because they can get other funding. But that's still a really great interest rate for projects.
Yeah, I would echo the need that capital stack and the creativity is even more important now. I think the concern is that return on investment. If you're taking a loan out, it's no different than home ownership with regards to if you're looking at buying a home now what you're paying in interest is very different than would have been a couple of years ago. And so, businesses are getting a little bit more. They're really sharpening the pencil to make sure it works. And in some cases, they've got to get creative with it. We don't do a lot of direct lending. We do a lot of technical assistance, though, and fund actually support with regards to helping the SBDC, and even like the small business grants that we had with the Main Street both grants during COVID. We actually are rolling out a program working with the SBDC to provide direct assistance to those businesses that received that funding to help them stay sustainable and help them grow into the future now, too. So we're seeing a lot more of those needs out there as well.
I was just going to share from our perspective. I think the macroeconomic environment it's a great question. I think we're all talking about it, but I also think about it from the standpoint of like, even though the macroeconomic environment is what it is, good opportunities and good startups don't take a break, and so it's really it kind of behooves us as a group and I guess venture investors more broadly, but to take advantage of those opportunities. Like if we were kind of sitting on the sidelines, we would have missed out on some of the biggest deals we've ever funded. We funded about $1.5 million in total this year, where we've actually doesn't count one or two other deals that's in the queue now still. So it's one of those things where it's like we just have to be opportunistic despite the macroeconomic environment and be kind of smart about where the valuation sits. But Midwest Games is one that if we were just kind of sitting back, the town a group startup that TitletownTech led their funding round, then we would have missed out on a great opportunity. So it's this balance between being opportunistic and yet not overly aggressive and trying to find your spots and your moments.
And I do think it's interesting looking at some of the data as well. So you still have a ton of funding at the seed level available. Now, whether it's being deployed or not is another question. But and then you haven't had, I think, the supply and demand. You haven't had as many deals actually hitting the market. Seen a lot of insider rounds. We started seeing that, I want to say maybe 9 months ago, we identified that. And before that, we were even trying to make sure we were being aligned with portfolio companies and with funds that potentially could be, having companies that would raise that wouldn't just hit the normal market. It would be funded by existing investors. So we've been brought in as a strategic investor. That has been very busy for us. It's been, that space has been very unique. And so when you look at the marketplace, innovation doesn't stop just because there's uncertainty in the market. It still has to continue on. And right now, innovation is moving at like the fastest pace it's ever have in its history. So as an investor, it definitely has tightened up in regards to the metrics that's required. Depending upon your stage, especially once you get to the point where you have a client. Like in some instances, we laugh as we think about it. It's almost better to not have a client because you have nothing to measure against. And so we see some of those companies actually getting more traction than companies that may have a client or two, because now they're being almost punished for doing the thing that they're supposed to do. So for us, we just try to stay very proactive and aware of what's going on in market. You have to stay aggressive in an environment like this, but you have to do it, with confidence, but also you can't be foolish and just be deploying capital into everything like we saw in 21 and 22. And that's the balance. It's like this, and it's a very thin line to walk on, but you have to find that space where we understand that in down markets, the vintages, the companies that happen in these down markets, typically they have opportunity on the back end if they can make it through this window.
If I can add to that, Eric, real quick. So Cordero mentioned a key point where, there is a lot of deployable or dry powder in venture right now, but a lot of that is currently inward looking at the existing portfolios. I see that in the 20 reports or updates I get from the 20 funds, but it's also because of the environment that we just went through, where there's companies getting funded at 20, 50, 100 plus X multiples on revenue. And lucky for the people or the LPs that work with TitletownTech is they don't chase those types of deals. So, but a lot of VC funds do, and now they're kind of stuck in this game of do we extend the capital to some of these companies that are a little bit bloated, if you will, and don't actually represent the traction that they have, or should we look at new companies? So there is a lot of inward looking with VCs right now, and that can be misleading because everyone's talking about, look how much dry powder there is, but that dry powder is not overly active right now as well.
Kind of protecting existing opportunities versus branching out into something new or taking a new risk. It's trying to protect what's already there.
Yeah, seeing which are going to survive too, and some of the ones that they aggressively, funded in that really crazy environment in 2021.
Yeah, well, I think there's some great insights there, and I think that question is important because the current environment really dictates probably the next set of questions that we have, and what each of these folks look for when they go to invest in a new startup or recommend investing in a new startup or nurture that. It sometimes is dictated by the current economic environment as well of where they can extend themselves and where they can't. So my next question is really kind of getting into what do you believe are the kind of some of the key deciding factors that you really look for in making a decision and investing in a startup? So when you're think about when your first approach, like when you see something, what really perks your interest or has you move forward? Like what are those key deciding factors that really make the difference in moving forward in a conversation with an early stage startup?
So you want to start?
Who? Cordero.
So I see a trend. I start, or I finish, or I start. So I think just because the environment has changed, the basic fundamentals of, is it a strong team? Are they solving a real and meaningful problem? Is it a large market that they can scale into? That hasn't changed. That principle is, for any investment, that's the baseline. What has changed, and it depends on stage. If you're a seed stage company and you have a couple of pilots and you've set milestones, the diligence on, have you been able to achieve those milestones that you said you were going to hit, or have you even been able to get close to those? Are you receiving market traction? Is your product actually in the pilot producing any type of results that are real? There's been just a lot more scrutiny on those companies, and then you get to Series A, as you should have more traction and more revenue. The scrutiny is even higher. So the threshold, the bar to get investors to fund, your next round, it's been elevated as high as I've seen since I've been in the market in the last 5 years. And so, looking at companies that are trying to raise, I think there's a few things that you need to think through. Because, all of a sudden everyone is, then you end up in that that cycle of, the bridge to nowhere. Again, are you and your team solving a real problem? Are you pursuing it in a way that the market can relate to? Do you have any type of traction that you can validate or prove? And then are you aligning with the proper funds? I can't tell you how many times we get reach outs from people looking for capital, and if they just look at the website, they wouldn't spend time because they would know we're not a good fit. And so also finding those funds that are investing, or angel groups, or state funding that aligns with what you're building towards is huge.
I could take a little something too, because it's completely different. It's similar but different. A lot of times the city is kind of more of a traditional funding is kind of how. So taking a look at some of the traditional resources is similar to a bank, but we're not a bank, and so we look actually because we know we're gap financing. We know sometimes we're a funding resort of last resort kind of a thing. And so we often will look, when we're going to fund a startup business, we're looking at the character of the individual that's coming. Are they going to quit on the first bump in the road? Are they determined to make this idea happen? How vested are they? Are they all in? Are they partially there? Are they just doing this as a side thing, or they really want this really to happen? And so I think there's a lot to be said for somebody that is all in, has a great story, is organized, knows their data, knows their information. When they come to us with that information, it really builds their case so much better, and it makes it a lot easier to fund and bring that to our local committees.
I can piggyback off of that a little bit because we have some similar stuff where I just say it differently. Ooh, sorry. That's loud. The why somebody like whether it's a fund manager or a founder, why are they doing it? But really peeling that back, why? Because a lot of founders and VC managers just got in the game in the last couple of years when cash was really flush and everywhere. And as some of the panel was saying before, innovation doesn't stop. So it's finding those people that are on a mission and are very, very resilient and determined. And that is usually, you can get some insight by understanding why they're doing it. I mean, another thing for family offices, just in general, like having a compelling case of like, why does it make sense to partner with this family office? What can they do beyond capital for you? That's really important, because a lot of people don't understand if you're investing with family or working with family, you're risking a lot more than just capital. So most family offices are not just going to spray and pray into a bunch of deals. They really want to understand the people that are leading those deals. And a lot of the families that I know and work with in venture, they look at the individual and say, do I want to work for them? Do I want to help them on my worst day? Will I pick up their phone? So really understanding the character and the drive behind what they're doing, on top of a lot of the quantifiable and common stuff that people will look for as well. But those are just some of the things that we look for when working with founders and VC managers. The other thing too is not, desperation can be pretty brutal, where if you're looking for that magic bullet for a funder or something, that funder will not want to be on an island by themselves. So having more confidence and conviction of like, I'm doing this no matter who's involved type thing, can go a long way with family offices versus trying to be the saviors for startups.
I think the only thing that I would just add, that you covered kind of the fundamentals really well. Everyone did. And the only thing I would just add from a venture perspective is just asking the question, why now? Like, why is this startup going to win now? Why is this the point in time for this to work? And I think there's a couple of things that in different industries that we've seen successful. For example, like COVID has kind of been kind of a big kind of equilibrium for a lot of different industries, and people having to change how they kind of do work in different industries. So like, for example, we invested in a company called Pivotal Health, which is earlier this year. We funded their round, and they kind of do house calls for hospital systems. And so hospital systems are under a lot more pressure than they've always have been under pressure, but a lot more under pressure from COVID. And so Pivotal Health recently partnered with Prevea Health probably about 2 months ago to kind of be their kind of mobile arm to reach their patients. So they saw that as an opportunity. So it's capitalizing on opportunities like that makes sense at the point in time. And I would just say the entrepreneur, I always ask, like, why should this happen now? And believe it or not, a lot of times the startup founder doesn't really have a great answer for that. They're just like, yeah, well, because it's never been done. Well, that's not a really good answer. There needs to be some sort of why now story behind it, because a startup needs to ride a wave greater than the sum of its parts. And a lot of times that's a societal, that's a technology, that's a kind of a customer wave and trend that they need to observe, but before the wave crests, and they need to be in the right moment at the right time. So that's the only thing I would say.
And I'll add to that, I think even that kind of connects other pieces, is that I think we're also looking at the economic well-being, right? How does this project elevate the economic well-being of the state? And for those of us that are in economic development has changed significantly over the last number of years, where it's just been business growth as the only primary focus. It's really now the quality of the community and the quality of the life that we're providing to everybody, whether that be childcare or healthcare. And so as we look at, and nobody has a great solution yet. So those new ideas, those innovative ideas become very important if we're going to try to help create great communities. So that's something that we always look at too.
Yeah, that's some great context for sure. So piggybacking off that a little bit, I think we started to touch on this slightly, but where do you think that you really add more weight? Is it the founding member? Like we were hearing you talk about, Wendy, where it was really the story of the individual, their grit, how are they going to move forward? Can we count on this person to not give up right away? Or is it more around, business traction, metrics, timing? What do you feel like you put more weight to between the founding team, I would say, and the traction of the current product or business?
People matter.
I was going to say,
People matter more than anything else. That's a big factor.
Yeah.
Kind of off the last question, kind of part two is that we put more weight in the character in an application, just because we know the product is going to be continually changing. And so it may not be the product, but it's maybe the concept, the idea, what they're putting together, what are they trying to solve? because they're going to continually evolve if they're going to meet the market or whatever it is. So we may put more into the weight of the team that's put together. How are they? Is there a nice diverse team with all different kind of individuals from different thought patterns? And if it's still a sole proprietor person, what kind of support do they have? What if they put them? How are they putting themselves in some kind of success arena? Could be a board, it could be a peer mentoring group or whatever it is. But I would say definitely the team and the individual has probably we focus on that first, and then probably the product and what they're trying to do and accomplish second.
Got it.
I can go next, and so I can kind of combine both of those. I mean, yes, it's focused heavily on the people first, but we don't look at the traction as much because we're so early with pre-seed and seed. Yes, the traction matters, but what matters even more is the team's operational velocity, especially around products. So like, how often are they improving it? Is that compounding over time? I mean, there's several times where I've watched a startup for a couple months and they've made incremental strides in a lot of their key metrics that I didn't think that they would get there, and it made me reevaluate and take a look. So the operational velocity of the team is something that's very, very important for early stage that we focus heavily on, because if you incrementally get better, like a small percentage each day, that compounds significantly over time, and we look at that the same way for startups. So it's not really the traction to date, and it's not just the skill of the people or their background, but it's also like, how do they work together and what kind of velocity do they have as a cohesive group to build what they're building.
Yeah, I love that. Love that for sure. Bunch of small steps make a big movement, right?
Yep.
And going after that. So if we're not really focused, I don't want to speak in a blanket term here, but focus more on the founders. What are maybe some common misconceptions, or where do we see founders getting it wrong when we start to talk to them? You know, I hear a lot of stories on my end, or we look at founders that come and try to work with Headway initially that they need to raise in order to do that, or they want to move forward, and we're trying to guide them in that right way, that are looking through maybe their current market and the opportunity that's there in a disproportionate way from what we believe was really going to be there. Maybe speak to that aspect of it a little bit of, you know, the opportunity that's presented inside of the startup that you're evaluating, and maybe some of those things that you're doing to, I guess, check that initial, I guess, sizing of the market that usually most startups are trying to portray that, hey, the opportunity's here. You know, maybe it's a little bit different than the timing, but maybe some of the financials.
I mean, I'll share a specific example. So, as a startup founder, when I had a startup, this is just kind of wild and just kind of think about like what I thought then, but that's life changes and experience change. But I used to think that money solved all problems, and so like all I needed to do was raise, and then I'd be able to build out a product. Then the rest is history. I'll just kind of fly right up the stairway to heaven, and we'll get this great exit. And specifically, I've been corresponding with a founder this past week who basically the situation was, person said, I have a MVP, I'm doing this as a side hustle, I need to raise a round to go full time so that I can, build this out, so on and so forth. And, I noticed the thought pattern was exactly the same as I had thought once, which is all you have to do is like build it or raise it and then build it and customers will come. And so my pushback was like, it's hard to hear, but I encourage keep it a side hustle until you know that you've got many customers that are paying you money on an ongoing basis, because otherwise you're kind of raising with the risk that you're going to build a product that goes nowhere. And the challenge is, and this is kind of counterintuitive, but really tight financials and constraints on financials create a lot of focus on execution. But if you raise $500,000 and you're like, well, here's a product I think we should build, then you all of a sudden you have time, years, and frankly guessing. You just have too much surplus and too much kind of resources at your disposal to go figure it out, quote unquote. So I say, that's maybe a more specific example. My encouragement to that founder was, don't leave your side hustle, don't leave your full-time job until you could actually prove out from a demand perspective, you've got customers paying, and that the product you built is the one that they actually want and will pay for. Otherwise, it's just too much of a risk. you know, especially in today's environment where it's like full-time jobs are, I mean, it's, there's a lot of people who are on the sidelines looking for work, right? So like, don't be so quick to leave your full-time job at the expense of hoping something will work out.
Yeah, I might counter and say this competing line of thought there. We don't invest in anybody that's doing something part-time or for a hobby. But to Matthew's point, you can do a lot of stuff with discovery, like work around talking to customers, talking to users, and like proving out hypotheses before you're fundraising anything. And I will say too, me in the VC game and seeing some of these startups get funded millions and millions of dollars and them being very, very bloated and rudderless is awful. It's a terrible, terrible experience. So incremental funding can actually be a great blessing, like what Matthew was talking about with focus. But I think proving it to yourself with the discovery work up ahead of time to see if there's a market or an opportunity there is really, really important before you go and do take that maybe leap full time without a safety net. But also realize too that most investors are not going to get excited if somebody's just working 6 hours on this a week, because you're going to be competing against people that are working 80 plus. So think of it that way as well.
Yeah, and we're in that same camp. I mean, that's one of our rules is we don't invest in part-time founders. And at the same time, you can make a ton of progress early on, just locking in with your own capital before you go to, or again, finding those friends and family that can help fund you before you go out to the broader market. I think the one thing that we see a lot, especially when we're looking at pre-seed, someone trying to get something off the ground, is them building the product that they would buy versus really getting out and understanding what the broader market wants for their product or the issue that the broader market has. And so we talk about not building in an echo chamber where you're just with your own thoughts. It's going out and trying to find different ways to get feedback without maybe sharing with the entire world exactly what you're doing, to make sure that you're aligned with what the market may be receptive to. Because again, early on, you're just trying to figure it out and maybe iterate and get some feedback and make small adjustments so you can get down a straighter path.
The other thing I would add is to really understand your financials. With that, understand the market and having all that, but then also the other really important component to that is understanding really how all these numbers fit together. What is this? How is it selling? Where is it not selling? Like to really have an understanding of your financials and don't have them inflated when you come to pitch that. I think it's better to be on the conservative side because we all like to be pleasantly surprised, but it's really hard when you're not meeting your market. It's a lot of frustration and it's very stressful. And so not only understanding the market, but understanding your financials and how they fit together. I know when you see people on Shark Tank and things, person may start asking as they start drilling, how much did you sell and how much is your margins and things like that. And so to really understand how all these pieces fit together is really critical. So we're going to bring that to our committees as well. And so having a solid story like that is so helpful.
Yeah, so I think just kind of listening to it there's a lot of ways that you could get traction on your own first and start to build that story, right? It's going to be a story of your grit and what you've brought into the actual business idea, how you've addressed the market, how you're sizing that market, what that looks like, alternative sources of funding, which I think what Cordero was starting to get into with friends and family rounds, or maybe there's a grant or something like that could happen from a state or city level to get you started in a more full-time context. And then you can go into the VC game or try to raise an initial pre-seed round where you're all in at that point. And you've done your homework, you've got everything together. And that's probably what separates people who are most successful versus not. And that kind of goes into my next question is, if you look back over the recent businesses or founders really that you've invested in recent memory, what do you feel like is separating them from the ones that maybe didn't? And you kind of had one example there, Matthew, but maybe tell a story around that, hey, we've had great success lately with founders that are approaching us in these ways with this, and it's kind of separated them from the pack.
You're talking about before the investment or after the investment, observing the founder's behavior? Afterwards? Okay. I'll share one. This was probably end of last year, one of our portfolio companies was going through some financial challenges, and myself and one of our investors got on the phone with the CEO and basically started talking through a couple options, and really there was like kind of 3 critical moves that needed to happen that the CEO, to make it work, had to do. And they were bold. It was bold. It was not just one bold move, but it was a series of 3 bold moves. And this person pulled it off. And over a series of kind of weeks, checked in later, and the person said, like, this is what's happening, here's where our runway is. And myself and the investor who was on the call were just like, virtually high-fiving one another, because it's that, well, I call it kind of I'm so glad I invested in you moment that you don't really see before the investment. You hope that's there, but like you do the best you can to vet out the team. But it's almost when you post-investment, when you look back and be like, oh my gosh, that's gutsy, and that person actually pulled it off. That's one of those moments where it's like, yeah, that's the right team, So yeah, just anecdotally, that's just one thing I would share that we all hope to have. I mean, we don't want to have the company go in that situation, but that's really the moment that we all at some point want to see, when the going gets tough.
Yeah, we lead. So we, a lot of times, the companies we invest in, we work with the founders, set the terms, issue a term sheet, help them bring together the entire syndicate for the funding round. And through that process, there was, again, 21 to 22 got crazy, and I'm glad we didn't participate as much during that time in some of the outlandish funding rounds that Dave was talking about earlier. But it's kind of back to that, the original cycle when we started, where it took time to get that round closed. It wasn't happening in a week, and it wasn't rushed. You had time to negotiate. You had time to work with the founder to find the syndicate. And so through that process, for us, a lot of times you really get to see in the due diligence process how the founder is going to react to pushback, how they're going to handle their first set of 10 no's in a row. You get to find out how they're thinking about really building out that team, how they actually have a path towards getting to that point. And so for us, a lot of times it's spending time with them during that process. And then once you have capital, also making sure that they have the support needed after post-investment. And so we're very involved with our portfolio companies and the founders. But at the same time, through that process, typically you have those moments where you're like, yeah, like this was the smart industry leading expert that we thought they were. And you have that confidence that they're going to be able to execute. They may be green. We deal with a lot of first-time founders, so they may not understand it from an entrepreneur side, but there's a ton of resources in this community, in the region, to help support some of that. So that's for us, how we try to support post-investment and think through to give the founders the best chance to have success.
Just to add to those two without trying to be too repetitive, I think some of the other qualities that I've seen some of the better founders, so we mentioned it, resiliency, persistenceness, team velocity of how they're operating. But 2 other things that I've seen with some of our best performing portfolio companies is the closeness to the problem the founder is. And that doesn't mean that they have to have the problem themselves. Sometimes they do, sometimes they don't. For example, there's one founder that has a fintech solution that helps out small businesses, and he has 5 family members that have small businesses that have dealt with that exact problem that he is solving. And so that's another one as far as closest to the problem. And with the other kind of qualitative stuff I mentioned there. But another one is selling. And people always think selling is like customers or investors. But a lot of it too is actually vision for recruiting and surrounding themselves with strong talent that can truly help them scale. So selling a vision is something that I've seen kind of separate in recruiting great talent amongst that, sell is something that I've seen separate like some of the really better entrepreneurs that I've supported versus the ones that are still good, but just maybe not on that level.
I have kind of a fun story if we have just a few seconds, but we use some funding from WDC as well. So we partner with all kinds of opportunities, but this was an individual that grew up so she's Hmong and ended up in in all different kinds of scenarios, but she had been through this country, many different struggles and challenges. Females were not allowed to be educated. She ended up educating herself and becoming a CPA. She was working at an organization as a CPA. Things were not going real well during 2020 at her job, and she knew it. She was running the books and knew it. She said, hey, save the company. I'm going to break off and start my own company at this time. She actually looked in the backyard and saw an ice shanty and pulled it around to the front of her yard and pimped out her ice shanty, put some nice fixtures in there, and ran the electrical cord to her house because she didn't want to bring customers into her home, and just started her own CPA business through an ice shanty. And that's where I came into the story. I got to meet her after being in a refugee camp and hearing the story. She even had a prearranged marriage at 15. You can imagine coming home from high school one day in the U.S. and decide that your whole future has changed, that somebody else has made a future for you that you didn't have any choice in. Nowadays, teenagers would nowhere put up with that, I don't think. But anyway, so fast forward on, she called the city and said, I am applying for a Main Street Bounce Back grant because I have enough customers now and a base built that I need to have a bricks and mortar. So she ended up renting a space, paid for her rent with the WDC's Bounce Back grant. And so we had to write a letter of endorsement that this indeed was a real business, that she had customers that was going into the space. Well, fast forward, now it's 2 years, and her rent, her lease is coming up because she signed a 2-year lease in this space. And we just closed on a deal 2 weeks ago, and she bought a bricks and mortar. And now she's going to be starting not only a CPA business, well, she's going to bring all of her people over to her new location, but it's a property that has multiple buildings on it, and she's got a women and Hmong speaking incubator started because she would like to really support and give back to the cause. So it's really cool how these entrepreneurs go from like zero to hero and be part of that journey. And they're going to need all kinds of support every step of the way. So when they come into you, it's like, I don't know if they're started for the 5th or 6th or 12th time, but they're on their journey, and it's important to be part of that, whatever that may be. So anyway, it was just great thanks for sharing that, let me share. That's pretty cool. So
I'm sorry.
Yeah, that's a really powerful story.
Yeah.
I mean, it just, entrepreneurship can come from anywhere. It's pretty crazy to think that you could instill confidence in others doing CPA work out of an ice shanty, but was able to get clients that way. And that's probably the definition of scrappy right there.
I just think it's a great story, but it's her life, it's real. And so, it doesn't get much real than that. So
Yeah, I love it. We're coming up on time, and we're starting to bridge the gap into what my last question was before we open it up to see if we have any questions here in the audience. But really my last question is, let's end with some, like, a founder's mindset, entrepreneur's mindset, like some practical, what do you feel like are some words of wisdom, or how you can instill some confidence and success in those that are listening into heading into their next round of raising capital? I know they've gotten a lot of insights over the course of the questions here, but that one thing of, hey, this is it, knowing that it's hard, right? You're going to get a lot of no's. Like, how are you going to handle that? What happens when someone says no? Do you press in? Do you give up? We talk about the qualities that are necessary in raising and the qualities that we want in the individuals themselves. But kind of, what are your parting words of wisdom, I guess, for entrepreneurs out there that might be on the fence, that have an idea, but they are not confident in moving forward? And, let's give them that nudge to want to do more and hopefully be more.
I can go first. I think, I think incremental improvements, so testing out different stuff incrementally, there's nothing wrong with that before raising capital and deciding what path you want to take. And if you are raising capital, I would just make sure that you have a plan for how much capital you want to raise. And that plan is not just like a high-level pie chart of like marketing, development spend. Like, it's got to be like actionable. Like, after this round, what quantifiable metrics are you trying to achieve? Because if you don't have that laid out, you're not going to instill any confidence in the investors putting the money to work, because they don't know what you're building towards. So understanding that is really, really important for investors, and I think entrepreneurs as well.
Yeah, now just to chime on what I said earlier, I just think there's only so much time in the day, and founders are responsible for so many items. I mean, you're literally the janitor to the CEO in an early stage business. And so making sure you allocate the right amount of time to talk to the right people. And so that little pre-work on making sure you're talking with funds that align with the stage you're in, that the metrics align with what you're, with where you are, and then that they invest in the space that you're in is huge. Like, there's a lot of good introductions, but not every introduction is a good introduction if it's just completely misaligned. And so taking the time, especially in this environment, to make sure you're getting in front of the right, I call it the right no's sometimes, but the right yeses or no's, right? Making sure you're talking to the right people, because they may pass because it's not a perfect fit, but usually even if you're in the close to the right space, they know other people that may be interested in what you're doing.
I would echo that, and kind of the little tagline is so much just talking to the right people, but also understanding what your own weaknesses are, understanding your blind spots, right? Assessing the risk, and then saying, okay, what else do we need to know? And who else do I need to bring on my team, right? What other advice do I need, and making sure you're surrounding yourself with the right expertise and the right talent. And don't make sure you, again, understanding your own weaknesses and your own blind spots, I think can help tremendously in making sure you have the right team in place.
I would say, I think execution drift is one of the biggest things for founders, just plagues them. Former founder, I think I wasted so much time on the wrong things, thinking that they were the right thing to do, but it didn't end up that way at all. And so I think the first thing is working with somebody who's either done it before to kind of map out, here's the journey here. And then the second piece is see if there's a way to get accountability on the execution, especially if you're a solo founder. Like I wasn't a solo founder, but kind of a complicated situation. But I was this CEO. My co-founder was part-time. So it was kind of largely up to me to kind of drive it forward. And I lacked accountability. I should have been accountable on an advisory board, but really needed somebody kind of on a weekly basis to be like, okay, why didn't you do this? And ask the hard questions, so that my effort could actually add up to something, as opposed to just looking back at the end of the week and be like, what did I do? And just kind of rinse and repeat week after week. So I would say accountability, in a word, is probably one of the biggest things to get on the execution side.
And along those lines, I've seen a lot of businesses that want to start up, and they're working on their business plan, and so much planning paralysis, though. They put so much time and effort into planning, and just that first baby step isn't even there. And just take a step, right? Just move one step closer.
And we talk about the no and how important that is. And I would say that's, if you think of it as you would have to pay a consultant a lot of money to tell you what's wrong with what you're doing. And so that no might be free advice for you to probably turn that into an opportunity. So the no is kind of like, what is missing? Where are we missing a piece here? What haven't I thought of? So that no might be very good advice for you. As a matter of fact, it's usually great advice for you. And to go back and say, roll up your sleeves, find the missing partner that needs to be there, the team member, the advice, the whatever it is, more testing in one department, whatever it is, to be able to find out, to bring everybody to yes, to say, okay, we figured out that missing piece. Let's go on to the next missing piece. Is there one? Let's have our next opportunity to try and figure that out. So by seeking individuals, very similar to what Matthew is saying, is like he wish he had an accountability board to tell him, hey, maybe what's the financial feasibility of that particular idea? Let's go back and look at that. And great idea, but how does that fit into our plan? And so I think that no is so critical. It's like not only, I know they always say, be friends with failure, but I think failures are just, you got to really create them as opportunities. So the no is really, and then what next? Yeah. So.
Yeah, I think that's a great perspective of looking at a no as free advice. You almost had a free consultation, essentially, to tell you where to focus and to get better. And it's on you on how you receive that feedback and take action on it, of what happens next. So love that. Well, thanks everyone for coming and listening. I hope everyone learned a little bit from the panel here. I want to thank the panel again for taking the time to come here and share some words of wisdom and advice from their experience on a day-to-day basis. But I want to open it up to if there's any questions in the audience. If anyone has anything that is on their mind that they'd like to ask, I mean, we'd love to answer it.
You talk a lot about getting in front of the agents to get the know. Can you give us tips on how you find those people to get the know?
Yeah.
Call Matthew up directly as soon as this topic or what?
Yes.
We're gonna have he's gonna hand out his card after.
This card, it says no. I'm just kidding.
Is there anybody in your industry that you admire or that you want to aspire to? Because I think that's one of the first audiences to get in front of. Like, how do you get to where they are? And so that'll start to kind of put the pieces together. They may guide you to find the people that are going to do that. But when you start to ask for funds, and you'll fill out applications, and there'll be information on there that they'll require. And it's like, I don't have this information. Where can I go get that? And so you might need a business plan, and that'll introduce you to one set of tools that are available in the community. And then you'll need this or that or whatever it is. You'll need some financial projections. What do those look like? And how do I find a retired lender or banker or somebody or SQDC or somebody that can help put those pieces together? So I think starting with those and getting that information, and then it'll start to gravitate. You'll get in front of somebody and they'll say, you're too early in this, in my opinion. You're doing well in that, in my opinion. So I think depending on what your situation is and where you are in your stages, I think you'll find plenty of people around to give you a no to help you improve your project and product.
Yeah. So my input on this is it's the old adage of if you ask for funding, you get advice. If you ask for advice, sometimes people want to fund you. So like sometimes how you position your outreach can be very critical. I mean, if you're saying, hey, I'm doing some discovery work, testing some hypotheses, it's in your industry, it'd be great if I could connect for a 15-minute call and ask you some advice on what we're building here. Oh yeah, we're raising $500K in the future if that comes up. But sometimes taking that approach, seeking advice or intel, even though you are fundraising or you will be fundraising, that can lead to more doors being open because a lot of people can be intimidated if it's like, okay, they're coming for funding. I don't know much about it. Okay, let me learn about it first, give some advice. Ooh, that sounds really interesting. Oh, they're funding. So like sometimes it's how like the outreach approach and how you take it. So
Great advice.
I think for me, I would just say, as a founder, I took in way too much advice from people who didn't know what they were talking about. And so if I were to do it over again, I would find 2 to 3 key people who have done exactly what I'm doing. In my case, kind of product-based fintech company that I was building, and have taken that to Series A and B, maybe even exited. So I would have followed their advice, because what you'll find, this is just, I guess, people try to be helpful. People are polite. They're not going to say they have no idea what they're talking about, and I don't know I don't know what the answer to your question is, but they're just going to make something up. What I found is you really have to understand the background of that person. And really, from what I understand, what I think is, has this person done exactly what I am looking to do? Because a lot of times I listen to a lot of service-based consultants that had no business, that never done a tech company before, but like thought that they knew the answers to my questions. I should have just been focused on like the 2 or 3 tech founders who had actually done what I was doing, trying to do, listen to them. I just took in way too much advice, and it was mind-numbing. It was kind of like, it was very confusing. So that's one of the things I would just say as it relates to kind of getting no's and getting the right guidance in the process.
And I just would add what you're doing now. So network, a lot of funding is tied to network relationships, connectivity. And so putting yourself in position where you're networked before you need it versus waiting to need it and then trying to network usually works out better. I just feel like that, especially in this community, especially in Wisconsin, especially in the Midwest, you're just more likely to get people that are willing to both of your points help, or all 3 of your points help, connect, and help you find a path to whatever you're trying to get to. So that's all I would add.
Love that. Hopefully that answers your question. Yes.
Top 1 or 2 blind spots for founders or founder.
Top 1 or 2 blind spots for founders.
Blind spots. Oh boy. I mean, I think some of the blind spots are what Cordero was referring to, where it's like, just because there's a venture firm and they have capital, like make sure it is actually aligned. I think there's actually a ton of bad fundraising advice that happens, and I won't go into that, but I think you really get, like, fundraising is more of a matching game. Does it match the thesis with what you're building? And not like, oh, they're an $80 million venture fund, they have $80 million, so I can get a piece of that. Well, I think that's the fallacy that a lot of entrepreneurs do not understand, is that a lot of these funds are very thesis driven. Even family offices are more thesis driven than you think. They just might not say it publicly. So I think a big blind spot is making sure the capital is an appropriate match and not just because they have capital.
Yeah, that's great advice.
I had a quick anecdote. The first ever investor conversation I had, I went to Silicon Valley for a conference. I sat down at this happy hour, and there was a guy who said, I'm an investor. And I started sweating because I was the first investor. I was like, oh my gosh, he's going to fund my company. It was like the first investor conversation I ever had. It was like, wow, how naive was that? You know?
Did you ask him when's the last time he deployed?
I had no idea what to ask. I just kind of I just basked in the sun of that he was an investor. I was just like, Google Gaga. Yeah, so anyway.
That's always a good question, though, too. Ask when's the last time they deployed. It gives you insight to how active they are as an investor.
Yeah.
I think one of the other blind spots that I think I see sometimes is that they know their product is awesome, but they haven't done a good job necessarily being able to communicate how awesome their product is, right? And it's kind of, it's even in Wisconsin. I think it's maybe in Wisconsin, our kindness, right? We don't like to boast. We're very modest, but so that maybe part of the personality, but we need to be proud of what the product is, and we need to be able to articulate how cool this is or what it's going to do, what's the benefit. And that gets lost. That selling piece sometimes gets lost, specifically if they're the inventor, right? If they're the ones that created it, that piece sometimes gets really lost in the mix.
Yeah, absolutely. And just to add to that, I mean, we've seen it a lot of times just in a consulting capacity of founders that have an idea and they're so close and tied to that idea. Every founder thinks that their idea is going to change the world, right? They're all chasing this big stuff, and they view the world a little bit through some rose-colored glasses where they think they know what the market wants, or they think they understand the problem, that this is really what the solution is. And until they've really got to talk to users or understand what the market wants, they can get into aspects of that lack of accountability where they're building the wrong thing that nobody's going to use. And I think that's definitely a blind spot that a founder has of not.
But it could be really cool still.
It can be really cool. It can be really cool. Yeah, for them.
For them.
If you want to build a business just for you, then that'll work out. But that's something that we see all the time, and that's really hard. Even when we engage with entrepreneurs or people that are like second-time founders, let's say, for example, that want to build an idea, they always believe that their idea is this is exactly what they want, and they're not as receptive to go out and do user research and those types of things, which I think is so important to building a product that's going to last and actually get in the market and stay there. So, all right, back there. All right, did everyone hear the question? All about resources of educating ourselves in finance.
I mean, so for me, it's a process. I mean, I started following the venture capital industry and startups in 2008, and I didn't start do my first startup until 2013. And then even then, I was super inexperienced because I wasn't talking to enough people. But as far as like local resources, I think the Tech Council has a book that highlights some different funds and funding options. But yeah, a lot of it depends on the industry and the stage that you're in. And it's kind of like a boiling the ocean question on how to get educated around it. But a lot of that depends on what you're fundraising for and where you're fundraising. But yeah, I don't have any like silver bullet, like this is how you get educated, other than by putting yourself out there, going to these different events and experiences. And the other thing too is you got to realize that, I mean, all different groups, whether you're a state group, a private family office, an angel group, a venture fund that has a fiduciary responsibility, all these people are driven by different things. So it's it's a process to figure it out. And I'm maybe making it sound more daunting here. I don't know if this is a good answer.
Yeah, no, I'm with you. So there definitely is. There's so many resources from, again, the internet. Now, some of that information may or not be true, but I think if you can get time with someone that's done it, and just to at least get an initial perspective, it's always huge, because then you can take the nuggets of things that you understand and stash those away, and then dig into the things you don't understand. Remember when I first started, I was given a few different books, venture deals. And then for me, my favorite is The Secret of Sand Hill Road. So for me, that's one of the better books that has a real term sheet in. It talks about all the different ins and outs of the process of getting to the point where you want to raise, and once you start talking with folks, how to negotiate. So that's one of my favorite books in this industry. But outside of that, I've learned a lot just from having in our world, having the opportunity to meet with a ton of people that's done it, and take nuggets from them, and then go back and steal, and then dig into a subject really deep.
One thing go ahead. I was just going to say, I think for a first-time founder, it's really important to understand what type of funding is appropriate for your business. Like, for example, angel investors and venture capitalists fund high-growth, scalable companies. And we've had a number of people who, because they're green and they're just learning the process of funding, they've reached out to Tundra Angels on the website and I'm looking to build a golf simulator. Will you help me fund it? And it's like, well, that person doesn't understand that we're not the right capital type for them. And so that would be one thing. And it just takes time to figure that out. So I would just say, for any business, understand the type of funding that's appropriate for you, and make sure you're spending time in the right places, right sources for funding.
I was going to add a little something when you're doing your research, that sometimes you think, I'm going to get a grant, and a big one. And it's like, so you go out and you try and find these grants. And then you'll find that there's loans, and then there's all these different capital funds. And you're trying to figure out which path and what fits your business best and what fits the investor best. And I guess the question for that is, or some of the answers to that is, sometimes when I look at somebody with an application and their funding has all come through grants, I also don't see a lot of personal vest there. I think that it's important to find several different resources. I'm not sure always a grant is the best thing coming in. Like, I'd like to see a lot of resources coming in and where they've figured out the path. So while it may be not an easy path, I think it's important to have several ways that you've solved your problem. Because if you only had one big grant and that solved your problem, I am very cautious about that structure. It hasn't had the trials that somebody with multiple resources has, with multiple ideas, multiple things that they've gone through. And so struggling through this and getting through these different funding sources, producing the results, whatever it is, if there's certain metrics happening on certain days, I think that's all very, very important. And so take a look at, fighting the fight and getting through those things, learning the ropes. And each one of those experiences are going to build to have a stronger business and the better pitch for the next time, and right on through. So I wouldn't, sometimes grants can count against you. I think some of this funding stuff, you really have to figure out what is really the best path forward. So not only looking for the funding, the right funding, and how does that affect your business story all the way through?
And while Wendy's talking a lot about grants, I will dispel the misbelief that there are grants out there for all businesses, because there are not. That is really, there's very rare instances where grants actually going to be able to come in and help start with business. Yeah. Most of the time. Right. The Main Street bounce back is that was a one-time shot for, to address COVID and vacant spaces. But if there are grants available, it's usually very targeted. It's very specific. And we're looking for very specific industries or something along those lines that will match up with the bigger picture for the state of Wisconsin, at least from our end.
I'd agree.
Great. Does that answer your question? All right, Jacob?
That is a great question. So how do you, when you're meeting with founders, how do you make sure the technology is going to be able to be in existence with the pace of innovation currently? So that's a real problem. It's a real thing that we wrestle with. Anytime we meet with any founder, we always ask, how is AI going to alter? How are you thinking about AI into your solution, and how will it impact your solution? And the crazy part is we were truly at the very, it's been we've been hearing AI at least my entire life, but it's really Like, it's here, it's real, it's happening. And so we're at the very early stage of what that looks like for us. And so there is a level of, you can just kind of tell where they're only solving the smallest part of the solution, like that's likely to be replaced. So it's really thinking through, what's your bigger vision of the company downstream? What does your product roadmap look like? What issue are you solving for long term? And sometimes we have founders that have that vision. They can speak through, well, I just got to do this to get to X, Y, and Z in here. And then some people are only trying to solve that one problem. And the crazy part is, depending on the space that you're in, sometimes solving that one problem right now is an acquisition, and that's a good investment too. And so we spend a lot of time just really trying to understand the bigger picture. How does that scale into a larger market? Does that founder have the team around them to scale and execute on that vision? And then we have to make estimated assumptions about where the market's headed. And that's just the nature of the business.
Yeah, I can chime in too. So for us, we invest in a lot of categories that we don't have the expertise, the technical expertise. So we work with a lot of fund managers that are the experts. So if I'm looking at something AI, I go to this early engineer at Palantir that better understands AI and some of the core technologies behind it. And yeah, we understand is this a feature? Is this a defensible technology? Or is this a wrapper on Chat GPT? Or like, what is this? So for us, we try to lean heavily on the technical experts that are doing this full time and not pretend like we know what we're doing, because we don't have like a back office with a bunch of tech people from Microsoft or somewhere that we can lean on. So we go to these, hey, just throwing out some examples. Just throw it straight. I'm sorry. I don't even want anymore. I'm thirsty. But yeah, let's try to find the technical experts to actually, and not just take the founders and founding team's word for it. So I don't think they were doing that before, because some of like the social investing, like who else is in, so-and-so's in, we're in type thing. But look at what happened with FTX and stuff, with the lack of governance there. But yeah, I think finding the technical experts to actually look at the underlying technology and say, is this defensible or unique? Or is this a dime a dozen and we see these all the time? That's huge. Microsoft's a great company, by the way.
For the record. All right, thanks, Jacob.
We separated them just,
Yeah, exactly.
Yeah,
Here, he's going to see me outside. Yeah.
the doorway's a long ways away from here. All right, anyone else have anything? Any other questions? All right, what's that? Yes. Thanks, LiveX, for the equipment and for setting this up for us. Sounds wonderful. And thank you to the panel for taking the time here to instill some wisdom in all of us who are entrepreneurial minded. So thank you, everyone.